Congratulations on starting your journey as a point of sales representative with Acuvisor. Welcome to the very first module in your online training program. Before we begin, let me introduce myself. My name is Rudraksh Singh. My colleague Lyra and I will be taking you through your POS training, which will be a total of 15 hours excluding tests. It is recommended that you do at least an hour's worth of training a day so you can easily complete this course in 2 weeks. The app will automatically save your progress and allow you to continue the course from the point you've left off. You can easily pass the test by simply paying attention to this course. Feel free to take notes, but more importantly, remember to pay attention so you can easily understand the concepts clearly. During the first module, we will be covering the following topics: Introduction to insurance, concept of insurance, history of insurance, insurance through the ages, what is insurance, purpose and need of insurance, concept of risk, peril and hazard, primary burden of risk, secondary burden of risk, risk management techniques, assurance versus insurance, role of insurance in society, features of life insurance, the premium. So let's begin with the concept of insurance. We live in a world of uncertainty. We hear about people falling sick suddenly, young athletes getting heart attacks, your neighbor's house getting robbed, young people dying suddenly, trains colliding, floods destroying entire communities, earthquakes that bring grief, sudden pandemics like the coronavirus killing people. Why do these events scare us? The reasons are simple. Firstly, these events are unpredictable. If we cannot anticipate or predict the event, we cannot prepare for it. Secondly, such unpredictable and unexpected events are often a cause of economic loss and grief. A community can come to the aid of individuals who are affected by such events by having a system of sharing and mutual support. The idea of insurance took birth 1,000 years ago. Yet, the business of insurance, as we know it today, goes back to just 2 or 3 centuries. Let's talk a bit about the history of insurance. Insurance has been known to exist in some form or the other since 3000 BC. Various civilizations over the years have practiced the concept of pooling and sharing all the losses suffered by some members of the community among themselves. Let us take a look at some of the ways in which it was applied. We'll now take you through insurance through the ages. Let's talk about the Babylonian traders first. For emergency loans, Babylonian traders had agreements where for an additional fee, lenders would write off their loans in case a shipment was lost or stolen. These were called bottomry loans. Under these agreements, the loan taken against the security of the ship or its goods had to be repaid only if and when the ship arrived safely after the voyage at its destination. The traders from Bharuch and Surat had practices similar to that of the Babylonian traders. The Greeks started benevolent societies in the late 7th century AD to take care of the funeral and family of members who died. The Friendly Societies of England were similarly constituted. The inhabitants of Rhodes adopted a practice where if some goods were lost due to jettisoning in distress, the owners of the goods on board, even those who lost nothing, would bear the losses in some proportion. Chinese traders in ancient days would keep their goods in different boats or ships sailing over the treacherous rivers. They assumed that even if any of the boats suffered such a fate, the loss of goods would be only partial and not total. The loss could be distributed and thereby reduced. Now let's talk about the methods of reducing risk in those days. Chinese merchants would distribute their goods across many vessels while traveling across dangerous rivers in order to limit their losses. Babylonian traders developed a system that was recorded in 1750 BC. If a merchant received a loan to fund his shipment or conduct emergency repairs, he would pay the lender an additional sum in exchange for the lender's guarantee to cancel the loan should the shipment be stolen or lost. It was called a bottomry loan, as the bottom of the ship was pledged and the ship was forfeit in case of a default. It was more money lending than insurance. Traders from Bharuch and Surat sailing in the Indian ships to Sri Lanka, Egypt and Greece also used a similar arrangement. In 800 BC, the citizens of Rhodes calculated average shipment costs. Groups of merchants would pay to insure the goods being shipped together. With this, any merchant whose goods were thrown away during transit in order to save the rest of the goods was reimbursed. These practices helped in the development of marine insurance. Insurance originated with marine insurance. Do you know when property insurance came in? During the Great Fire of London in 1666, 13,000 houses were burnt and destroyed. This catastrophe led to an urgent demand to find a way to protect homes and buildings. In 1681, the first fire insurance company named Insurance Office for Houses to insure brick and frame houses was established. At the same time, Edward Lloyd established a coffee house in London that became a meeting place for different operators in the shipping industry. Those who wished to insure their cargoes and ships, along with those who were willing to underwrite such ventures. Today, Lloyd's of London is the most important channel for marine insurance. The Amicable Society for a Perpetual Assurance Office, founded in London in 1706, first offered a life insurance policy that pioneered age-based premiums based on mortality rates. This laid the framework for scientific insurance practices and development. It also formed the basis of modern life assurance, upon which life assurance schemes were subsequently based. Accident insurance started in the late 19th century in the form of a railway passengers assurance scheme to insure against the rising number of fatalities on a new railway system. During the same period, various governments initiated national insurance programs against sickness and old age. In 1840, some states in Germany introduced insurance cover for old age pensions, accidents, and medical care. This was subsequently extended to the whole of Germany and became the basis of the German welfare state.
Now that we know a bit about the history, let's move on to what is insurance. What is insurance? Insurance is a legal agreement between the insurance company or insurer and an individual or corporate or insured. where the insurance company promises to make good the losses suffered by the insured on the occurrence of an insured risk. Insurers bring together people sharing the same risk or insurable interest and collect contributions, called premium, from all the insured people and pay out compensations, called claim, to these people who suffer a loss. The term insurable interest will be dealt in greater detail later on in Module 3. Let us now examine the definition of insurance in detail. The first part of the definition says that the insurance is a legal contract. Insurance is a legal contract or agreement. This contract spells out the terms and conditions on which it is based. This means that an insurance contract is a valid contract enforceable by law. In simple terms, it means that if any party is aggrieved or unhappy due to non-observance of the terms and conditions of the insurance contract, he can file a case in a court of law against the insurance company. The main essentials of a valid contract are as follows. Capacity. Even before the contract is planned or executed, the most important criteria for the contract is that all persons who have decided to opt for the contract have the capacity to enter into the same. For example, a minor or a mentally challenged person is not entitled to enter into any contract. Similarly, people with no insurable interest do not have the capacity to enter into an insurance contract. Simply put, a wage earner or a breadwinner and the people dependent on him for their living and well-being have an insurable interest between them. Legally, a person must have reached majority age, be of sound mind, and not have been disqualified by law to be eligible to enter into a contract. Legal relationship. A person cannot insure any property which does not belong to him for the simple reason that he is not going to benefit from its existence nor put to a loss by its destruction. To be able to contact an insurance policy, a person should have a legal relationship with the subject matter proposed for insurance. The insurance contract has to happen between people not only eligible and capable of entering into the contract, but also should have justifiable and legal cause for the contract. Let's go over some examples to get a better understanding of this. A tenant does not have any financial interest in a rented house. He cannot be a party to a property insurance contract for the house. A friend does not have any financial interest in another friend. He cannot be party to an insurance contract for his friend. The offer. To start the process for an insurance policy, a proposer has to fill in all the details in the proposal form. The law requires the proposer to request an insurance contract from an insurance company. The form is a declaration by the first party or proposer with regard to his financial, medical, as well as occupational status, along with his family history. These details form the basis on which the contract is finalized. Complete and truthful answers are required to ensure there is no reason for the insurance company to reject a claim. For example, Mr. Chakraborty took a life policy of Rs 10 lakhs and 2 years later, he died. The insurance company declined his claim as they discovered he was under treatment as an alcoholic for more than 2 years and was in the habit of drinking heavily for many years prior to that. This was not only verified by his neighbors, but proof of his frequent visits to Hospital X was also obtained by the insurer. The beneficiary was denied any claim as there was non-disclosure. The insurance contract was null and void as he had not disclosed the fact that he was under treatment in his proposal form. Acceptance. When the insurer is satisfied that the proposal form is correctly and completely filled, and with the information he has received in it, he may accept the proposal. Based on the report of the underwriter, a professional who evaluates the financial, medical, and occupational condition as declared by the proposer. And this will be discussed in greater detail in Module 3. The insurer may or may not agree to give all the benefits of the policy to the proposer and may restrict the policy to certain covers only. The insurer will then communicate the changes, if any, to the proposer and request him to pay the premium. After the payment of the premium, the offer is complete and the insurance company communicates its acceptance. The insured can then avail the benefits of the policy. Consideration. It is one of the most important requirements of a valid contract. The basis for any valid contract is mutual benefit. All the contracting parties must receive something of value to them. This value is called the consideration. In an insurance contract, the consideration is premium paid for the policy by the insured. Promise to indemnify in case of loss to the insured. When there is a loss to the insured in fulfillment of the promise, the insurer pays claim to the insured or to the beneficiary of the policy. To indemnify means to compensate. For example, Rakesh wanted to insure his new Kia vehicle with the new motor insurance company by filling the proposal form and sending it to the company along with his check for the premium amount. The car met with a serious accident resulting in a total loss of the vehicle. The insurance company rejected the claim since the premium check given by Rakesh was dishonored. The check with the premium amount was the consideration. However, as it was dishonored, the consideration was an invalid, making the insurance contract invalid. No contract, no claim, so it was rejected. If the check for the premium had been honored, it would have been a valid consideration, and the insurance company would have had to pay the claim. For example, Mr. Dikshit submitted a completed proposal form for an endowment plan of Rs 5 lakh with an annual premium of Rs 95,000 to ABC Life Insurance Company. The details on the form indicated that he is a smoker and drank alcohol regularly. On receiving the proposal form, the underwriter recommended acceptance of his offer but with a higher premium. Mr. Dikshit agreed to the new premium rate and paid the additional premium of Rs 25 per Rs 1,000. The insurance company accepted the risk and issued the policy. 6 months after taking the policy, Mr. Dikshit died in a road accident. Investigations found it to be genuine and the insurance company paid the claim. The insurance policy is a legal contract between the insurer and the insured. Insurer is the insurance company and the insured may be an individual, proprietor, a company or firm which is owned by an individual, partnership firm, a company owned by 2 or more partners, shopkeeper, corporate company, NGO, state government, central government, financial institution, cooperative society, etc. So here the insured fills in the proposal form in all respects and submits the same to the insurance company.
Now let's go back to the history of insurance in India. In India, insurance has a deep-rooted history. Variants of it are mentioned in the writings of Manu, Yagnavalkya and Kautilya. The writings talk of pooling resources that could be redistributed in times of calamities such as fire, floods, epidemics, and famine. This was probably a precursor to modern-day insurance. Ancient Indian history has preserved the earliest traces of insurance in the form of marine trade, loan, and carrier contracts. Life insurance started in India in 1818 with the establishment of the Oriental Life Insurance Company in Calcutta. Although the history of general insurance in India dates back to the early 1800s, when some foreign companies started fire and marine insurance, it had its roots in the establishment of the Triton Insurance Company Limited in the year 1850 by the British in Calcutta. In 1907, the Indian Mercantile Insurance Limited was set up. This was the first company to transact all classes of general insurance business. Many other Indian companies were set up subsequently as a result of the Swadeshi movement at the turn of the century. In 1912, the Life Insurance Companies Act and the Provident Fund Act were passed to regulate the insurance business. The Life Insurance Companies Act 1912 made it compulsory that premium rate tables and periodically valuations of companies be certified by an actuary. However, the disparity and discrimination between Indian and foreign companies continued. With a view to protecting the interest of insurance public, the earlier legislation was consolidated and amended by an Insurance Act of 1938, with a comprehensive provision for effective control over the activities of insurers in India. This Act, as amended from time to time, continues to be in force. The Controller of Insurance was appointed by the government under the provisions of the Insurance Act. An ordinance was issued on 19th January 1956, nationalizing the life insurance sector. Life Insurance Corporation of India came into existence in the same year. Life insurance business was nationalized in India on 19th January 1956, and the Life Insurance Corporation of India, LIC, was incorporated on 1st September 1956. There were 170 companies and 75 provident fund societies doing life insurance business in India at that time. From 1956 to 1999, LIC held exclusive life insurance business in India. With the enactment of General Insurance Business Nationalization Act in 1972, the non-life insurance business was also nationalized and the General Insurance Corporation of India and its 4 subsidiaries were set up. At that point of time, there were 106 non-life insurers in India. They were amalgamated into the 4 subsidiaries of GIC of India. In 1993, the government set up a committee under the chairmanship of R.N. Malhotra, former governor of RBI, to propose recommendations for reforms in the insurance sector. The objective was to complement the reforms initiated by the financial sector. Following the recommendations of the Malhotra Committee report in 1999, the Insurance Regulatory and Development Authority (IRDA) was constituted as an autonomous body to regulate and develop the insurance industry. IRDA was incorporated as a statutory body in April 2000. The key objective of IRDA included promotion of competition so as to enhance customer satisfaction through increased consumer choice and lower premiums, while ensuring the financial security of the insurance market. IRDA was subsequently renamed as Insurance Regulatory and Development Authority of India, IRDAI, in 2014. The first insurance company to be set up in India was an English company, the Oriental Life Insurance Corporation Limited. Triton Insurance Corporation Limited was the first non-life insurance to be established in India. Bombay Mutual Assurance Society Limited, formed in 1870 in Mumbai, was the first Indian insurance company. National Insurance Company Limited is the oldest insurance company in India. It was founded in 1906 and is still in business. The companies involved in life insurance today are Life Insurance Corporation of India, LIC, a public sector company, 23 life insurance company in the private sector, and the Postal Department under the Government of India. The Postal Department also transacts life insurance business via postal life insurance, but is exempted from the purview of the regulation of IRDAI.
Now that we have covered the concept and history of insurance, let's move on to the second part of this module, the purpose and need of insurance. Modern commerce was founded on the principle of ownership of property. When an asset loses value by loss or destruction due to a certain event, the owner of the asset suffers an economic loss. However, if a common fund is created, which is made up of small contributions from many such owners of similar assets, this amount could be used to compensate the loss suffered by the unfortunate few. In simple words, the chance of suffering a certain economic loss and its consequence could be transferred from one individual to many through the mechanism of insurance. Insurance may thus be considered as a process by which the losses of a few who are unfortunate to suffer such losses are shared amongst those exposed to similar uncertain events or situations. The purpose of insurance is to reduce your exposure to the effects of risk. Death too early. When a person dies, even before being able to arrange for the basic living expenses of his dependents, or for major life events like purchase of house, education of children's marriage, of daughter, etc., he leaves them in a crisis. A life insurance policy can help avoid this possibility. Death too late. When a person lives to a very old age and has not provided for a regular income for his old age or his medical needs, he places himself in a difficult position. He should buy an annuity policy. An annuity life insurance plan could help avoid this possible scenario. Incapacitated. When a person due to an accident or some illness is completely incapacitated and his earnings completely stops, he leaves himself as well as his dependents high and dry. An accidental cover and health policy can help avoid this. Insurance does not protect assets. It neither prevents its loss nor avoids a person's death. However, it helps to recover from the loss. So the basic purpose of insurance is a protection from financial loss. A new insurance area, as cyber data theft and data loss is a modern day problem, is cyber liability. Cyber liability covers the business liability that's arising out of a data breach involving sensitive customer information. So the basic purpose of offering cyber insurance is to protect the business from a potential loss. Thus, the purpose of insurance is to remove the fear, worry, and anxiety associated with future uncertainty and encourage free capital flow. Example A. Deepika is an extremely successful businesswoman and manufacturer of garments. The garments are manufactured on the most modern and highly sophisticated machines available and then marketed throughout India. Unfortunately, one day a huge fire destroyed all her machines and stock. Everything came to a standstill, causing huge loss. Example B. Ranveer recently purchased a new BMW X5 car. It met with a serious accident, causing heavy damages resulting in huge repair and replacement costs. Example C. Twinkle is a school teacher living with her husband and 2 children. Unfortunately, one day her husband suffered a massive heart attack and had to be hospitalized. The very high expenses beyond the reach of her family's income. Example D. Akshaya is an employee of a big organization, earning a reasonable salary. He is able to take care of his family that consists of his wife, 2 children, father, mother, and 2 sisters. Unfortunately, Akshaya dies due to a virus and there is no one to take care of his family. It becomes very difficult for his family to manage their current and future expenses. In all these 4 situations, Deepika, Ranveer, Twinkle, and Akshaya's family are in a hopeless situation where their normal life has turned into a nightmare. If they had insurance, they and their beneficiaries could have led a normal life. The above examples clearly illustrate the need for insurance. For example, Akhilesh, a fresh postgraduate, has taken a job which offers him a salary of Rs 45,000. He got married last year and has a newborn baby. He has taken term insurance of Rs 50 lakhs and a family floater health plan for a sum assured of Rs 10 lakhs. This way, he has protected his family from unforeseen events like death and hospitalization expenses. Now that you have a pretty good understanding of what insurance is, let's move on to the concepts of risk, peril, hazard. Let us first define exactly what risk, peril, and hazard mean. Risk is the chance of loss. It is the possible occurrence of a given event or events that would result in a loss with no opportunity for gain. In simple terms, it means possible events that result in loss. Peril is the event whose occurrence actually leads to the loss. It means imminent danger. Peril word comes from the Latin word periculum, which means danger. Hazard is the condition or conditions which increases the probability of a loss or its severity. It is any object, situation, or behavior that has the potential to cause loss. The entire concept of risk, peril, and hazard can be very well explained by the following 2 examples. Example A. A factory building was damaged by fire. The fire was caused by a faulty electrical switch, resulting in huge loss of Rs 50 lakhs. Here, the risk is fire. The fire that caused the loss is called the peril. The faulty electrical switch that increased the probability and severity of the loss is the hazard. Example B. Vijay is the owner of a very beautiful bungalow in Shimla, known for its cold weather and snowfall. The bungalow is also equipped with a fireplace to keep it warm during cold winters. Here, fire is the risk. If it occurs, it is the peril. And the fireplace is the hazard, as it increases both the probability and severity of the loss. Assets are resources that have economic value and are therefore reflected in the owner's balance sheet. A loss to assets means a loss of economic value and is the reason assets need to be insured. Assets are exposed to risks like fire, floods, breakdown, lightning, earthquakes, theft, etc. Such risks are called perils. When individual or corporate assets are destroyed by such risks or perils, he suffers huge financial loss. To protect themselves from such a huge financial loss, people need a financial security net. Insurance is the financial security net for the people's need in event of a financial loss. For example, Mr. Ravi is an industrialist with huge assets that include buildings, machinery, stocks, raw materials, stock in process, personal and commercial vehicles. A major fire broke out and 80% of his assets were damaged. As Ravi had taken a fire insurance policy covering all his assets and was indemnified by the insurance company, so he could recreate his assets. This enabled him to re-establish his business. Let's get an understanding of how insurance works. A. There must be an asset which has an economic value. The asset can be physical, like a car or a building, non-physical, like name and goodwill, personal, like one's life, eyes, limbs, and other parts of the body. The asset may lose its economic value if a certain event or mishap happens. This chance of loss is called a risk. The cause of the risk event is known as a peril. There is a principle known as pooling. This consists of collecting many individual contributions, known as premiums, from various persons. The persons in the pool have similar assets and are exposed to similar risks. This pool of funds is used to indemnify the few who suffer a loss caused by a peril. The process of pooling funds and indemnifying the unlucky few is carried out through an institution known as the insurer. The insurer enters into an insurance contract with each person who seeks to participate in the pool. Such a participant is known as the insured. An insurer initiates and organizes the process to bring members of the community together in a pool for the purpose of covering a risk. He determines the contribution that each individual must make to the pool and arranges to pay to those who suffer the loss. To be able to do this, the insurer must also win the trust of individuals and the community. They must be able to trust that their contributions are actually being used for the desired purpose. Their contribution is fair. The burden of risk refers to the costs, losses, and/or disabilities one has to bear as a result of being exposed to a given loss situation or event. There are two types of risk burdens that one carries: primary and secondary. Let's talk about the primary burden of risk. This consists of losses that are actually suffered by households or business units or lives as a result of pure risk events. These losses are often direct and measurable and can be easily compensated for by insurance. For example, If an individual undergoes a heart surgery, the medical cost of the same is known and compensated. In addition, there may be some indirect losses. A fire may interrupt business operations and lead to a loss of profits. This loss can be estimated and be compensated. Secondary burden of risk. There is physical and mental strain on most persons that is caused by fear and anxiety for the safety and health of their lives, their family, and their assets. The anxiety may vary from person to person, but if it is present, the stress can affect a person's well-being. Also, many people who are uncertain about any possible future loss keep aside a reserve fund to meet such an eventuality. There is cost involved in keeping such a fund, as such funds are mainly held in a liquid form and yield low returns. By transferring the risk to an insurer, it becomes possible to enjoy peace of mind, invest funds that would otherwise have been set aside as a reserve, and plan one's business more effectively.
We will now take you through some risk management techniques. Insurance is only one of the methods by which individuals may seek to manage their risks. Here, they transfer the risks they face to an insurance company. However, there are some other methods of dealing with risks. Risk avoidance. Controlling the risk by avoiding a probable loss situation is known as risk avoidance. Thus, one may try to avoid any property, person, or activity with which an exposure to risk may be associated. For example, one may refuse to bear certain manufacturing risks by contracting out the manufacturing to someone else. One may not venture outside the house for a fear of meeting with an accident, or may not travel at all for a fear of falling ill when abroad. However, risk avoidance is a negative way to handle risks. Individual and societal advancements come from activities where some risks need to be taken. By avoiding such activities, individuals and societies would lose the benefits that such risk-taking activities can provide. Risk retention. When a person tries to manage the impact of risk himself and decides to bear the burden of risk and its effects by oneself, it is known as self-insurance. For example, a business house may decide, based on its experience and capacity, to bear small losses up to a certain limit, retaining the risk with itself. Risk reduction and control. This is a more practical and relevant approach than risk avoidance. It means taking steps to lower the chances of a loss occurring and reduce the severity of its impact if such a loss should occur. The measures taken to reduce the chances of it occurring are known as loss prevention. The measures to reduce the degree of loss is called loss reduction. Risk reduction involves reducing the frequency and the size of the loss. Education and training on diet control, health and hygiene, regular exercise regime may reduce the risk of illness. Making environmental changes, reduction of environmental pollution, and improving medical facilities will certainly improve life expectancy. Now, let's understand the difference between assurance and insurance. Both insurance and assurance are financial products offered by commercial insurance companies. Lately, the distinction between the two words have become increasingly blurred, and the two are being used interchangeably. However, there are subtle differences between the two. Insurance refers to protection against an event that might happen, whereas assurance refers to protection against an event that will happen. Insurance provides a cover against a risk, while assurance covers an event that is definite, like death, which is certain, with only the time of its occurrence uncertain. Assurance is associated with life insurance policies. Now let's try to understand the role of insurance in society. Insurance companies play an important role in a country's economic development. They contribute significantly by ensuring that the wealth of the country is protected and preserved. Some of their contributions are collected as premiums and held for the benefit of the policy holders. Their investments made from the funds they hold benefit society at large. Insurance provides numerous direct and indirect benefits for the individual, his family, to the industry and commerce, and to the community and the nation as a whole. The insured, both individual and enterprise, directly benefit as they are protected from the consequences of a loss that may be caused by an accident or an unfortunate event. Insurance protects industry's capital and allows it to be used for further expansion and business development. Insurance removes the fear, worry, and anxiety associated with one's future and encourages free investment of capital in the business enterprise. It also promotes efficient use of existing resources. Thus, insurance encourages commercial and industrial development along with generation of employment opportunities, thereby contributing to a healthy economy and an increased national productivity. A bank or a financial institution may not advance loans on property unless it's insured against a loss or damage by insurable perils. Most of them insist on assigning the policy as collateral security. We will now briefly discuss the features of life insurance. The features of life insurance and its various components include the asset, human life value, HLV. We have already seen that an asset is any property that has value or gives a return. For most types of property, the value can be measured in precise monetary terms. Similarly, the loss of value can also be measured. For example, when a car meets with an accident, the amount of its damage can be estimated. If it is Rs 50,000, the insurer will compensate the policyholder for the loss. However, how do we estimate the amount of loss when a person dies? Is he worth Rs 50,000 or Rs 5 lakhs? Solomon Hubener, Emeritus Professor of Insurance at the Wharton School of the University of Pennsylvania through the first half of the 20th century, developed the concept known as human life value, HLV. This is used worldwide to calculate a person's life value. It considers a human life as a type of property or asset that earns an income. It measures the value of a human life based on the expected net future earnings of an individual. net future earnings means the income a person expects to earn each year in the future, less the amount he would spend on himself. It indicates, in monetary terms, the economic loss a family would suffer if the wage earner were to die prematurely. These earnings are capitalized using an appropriate interest rate to discount them. To measure HLV, we divide the annual income a family would like to have, even if the breadwinner was no longer alive, with the rate of interest that can be earned. For example, if Mr. Rajan earns Rs 1,20,000 a year and spends Rs 24,000 on himself, the net earnings his family would lose were he to die prematurely would be Rs 96,000 per year. Suppose the rate of interest is 8%. HLV 96,000 divided by 0.08 will equal Rs 12 lakh. Mr. Rajan's human life value is Rs 12 lakh. HLV helps to determine how much insurance one should have for full protection. It also tells us the upper limit of insurance cover beyond which the insurance policy would be speculative. On average, the amount of insurance cover a person requires is around 10 to 15 times one's annual income. In the above example, if Mr. Rajan was to ask for an insurance cover of Rs 2 crores while earning only Rs 1.2 lakh a year, it would be suspicious. The actual amount of insurance purchased would depend on factors like how much insurance one can afford to buy and would like to buy. HVL must be explained by an insurance professional whenever he or she meets a customer. It is the basis on which the agent can determine how much insurance to recommend to a customer. Let's understand the premium. As we have seen, life insurance provides protection against those risk events that can destroy or diminish the value of human life as an asset. Since mortality is related to age, life insurance companies charge premiums that change depending on one's age. Older people are charged higher premiums than younger ones. One result of this was that individuals who were older but otherwise in good health tended to withdraw while unhealthy members remained in the scheme. As a result of this, insurance companies faced serious problems. They sought to develop contracts whose premiums were affordable and therefore continued by individuals throughout their lives. This led to the development of level premiums. A level premium is a premium that is fixed and does not increase with age. It remains constant throughout the contract period. This means that premiums collected in early years would be more than the amount needed to cover death claims of those dying at younger ages, while premiums collected in later years would be less than what is needed to meet claims of those dying at a higher age. The level premium is an average of both. This means that the excess premiums of early ages compensates for the deficit of premiums in later ages. Level premiums are used in life insurance contracts, as are typically long-term insurance contracts that run for 10, 20, or many more years. On the other hand, general insurance contracts are typically short-term and expire every year. Level premiums have two parts. The first is known as the term or protection part, consisting of that portion of premium actually needed to pay the cost of the risk. The second is known as the cash value element. It is made up of accumulated excess payments of the policyholder. It constitutes the savings part. Almost all life insurance policies contain a mix of protection and savings. The more the cash value element in the premium, the more it is considered as a savings-oriented insurance policy. That was the end of Module 1. You will now be tested on this module. Good luck!